Warning, the secret shadow score, stealing your future. What's your secret shadow score right now? Not your credit score, the one you never see, built from your phone, your apps, your late-night scrolling. It just priced your rent, bumped your car insurance, and flagged your job app. No warning, no appeal, just a number you don't control. Here's what actually happens, and why it's costing you real money. I'll show you who builds it, LexisNexis, SafeRent, and friends, how they score you off alternative data, and the exact moves to fight back. One thing changes everything near the end. Don't miss that. Let's pull the thread and see who profits. Your life is now priced by a hidden score. Okay, so here's the thing. Most people think risk is about credit files and FICO. But your life now gets priced by a hidden, real-time score built from behavior. It changes as you move, browse, buy, and sleep. It's not regulated like your credit report, and you don't get an adverse action notice when it dings you. That's the shadow score. What feeds it? Alternative data. Your phone number, your device ID, your email graph, your app list, dwell time on pages, late-night activity, battery patterns, location pings that say you commute long, hit a certain bar, or visit a payday lender, purchases, subscriptions, chargebacks, the MPL history, telematics from your car, even address stability and phone tenure. It's all fair game. Who stitches it? Data brokers like LexisNexis Risk Solutions, owned by Arroyo. They run products like RiskView and RiskView Spectrum that pull in utility payments, phone bill timeliness, public records, and device graphs to guess your stability. They link your phone, past addresses, emails, and IPs into one persona, then sell risk signals to insurers, landlords, and employers. You never see the file that matters. How does that hit your wallet? Dynamic pricing and risk tiers. Same product, different price because the model thinks you're a higher loss risk or a higher churn risk. Auto insurers plug into telematics exchanges and claims databases to nudge your premium. Landlords run tenant screeners like SafeRent Solutions, formerly CoreLogic Rental Property Solutions, to spit out an approve/decline in seconds. Marketplaces and property managers feed those outputs straight into deposits and fees. You're risky, so you pay more now. Private equity loves this. They roll up data brokers, screening tools, and pricing software into bundles they can cross-sell across housing, insurance, and hiring. It's neat for them. Each layer makes more when your tier inches up. Higher premiums, higher deposits, more add-on fees. And because the models sit outside old-school credit laws, visibility stays near zero. You feel the cost, but you can't point to a line on a report and dispute it. Why don't you see it? Consent is buried in cookie pop-ups and terms you skip to use a map, book a ride, or pay a bill. App SDKs vacuum metrics by default, then pass them to partners, who pass them to exchanges, where they get hashed and anonymized, then quietly reling to you through your device, email, and address history. If you asked for your credit file, you'd miss the real pipeline because it doesn't live under that label. Early signals are everywhere if you look. Rental screenings now decide not just yes or no, but the size of your deposit, the pet fee, even conditional approvals. Usage-based insurance started as a discount if you drove safely, then turned into midterm premium hikes for hard-braking and late-night trips. The NPL limits dip after too many returns or cart abandons. Airline fares nudge up after repeat searches. You don't get a letter explaining any of it. Now you might be thinking, isn't more data fairer? That's the pitch. But here's where it gets interesting. Many stability, proxies recreate bias without naming it. Zip code correlates with race and income. Commute patterns signal class and shift work. Frequent moves can mean you're young, divorced, or priced out. Not that you're unreliable. New phone line. That might be a cheaper plan, not fraud. The model doesn't care. It sees higher loss odds in the training data and taxes you for the pattern. And the training data? Labels come from past claims, evictions, court filings, chargebacks, and approvals that were already shaped by older biases and errors. Screeners like SafeRent learned good tenant from landlord outcomes that include noisy eviction filings, many dismissed or settled. Insurer loss data can reflect who gets policed, who reports, and who has coverage. Feed that into a model, tighten thresholds via API, and you lock in a feedback loop. The risky get priced out, so the risk seems to validate itself. Let me give you a quick micro-story. Last week, someone told me their rent, quote, jumped after they reapplied to the same building. Same pay, same job. The only difference? They'd installed a free budgeting app that linked their bank. Within a month, they saw more pre-approval spam and got a conditional approval for the apartment with a fatter deposit. Coincidence? Maybe. But that's how the shadow score feels. Death by 1,000 tiny maybes that add real dollars. So what's the bottom line? You're living inside a risk market you didn't join. Your habits are inputs. Your prices are outputs. The model updates in the background. And because the rules were written for FICO-era files, not phone-era exhaust, you're exposed. The longer you wait, the more history that score can lean on, and the harder it is to move your tier. You need to know this. It's not about turning off your phone and hiding. It's about breaking the data links that inflate your tier, forcing human review when it matters, and using new rights where they exist. We'll hit the playbook soon. First, we need to see how fast this scaled and who's cashing in. Urgency, the speed run from niche to normal. Everything changed when smartphones turned into sensors. In the early 2010s, ad tech learned to follow you across sites and apps. Fintech looked over and said, wait, those trails can price risk. That's the pivot. Ads met underwriting. And once data got cheap, models got bold. What started as show better ads became decide who pays more. Then the pandemic hit and stepped on the gas. Contactless everything. Delivery for basics. Telemedicine. Remote signups. Telematics devices in cars. Every yes, to keep life moving, normalized constant tracking. Risk teams got a fire hose of new signals. Habits hardened. The software stayed. Now, this is important because the cloud turned pricing into a plugin. You don't need a giant in-house team. A landlord on RealPage, a mid-size insurer, even a marketplace can hit an API for loss odds or a rental risk band. Third-party models, often fed by exchanges like LexisNexis Risk Solutions, slot into forms you already fill. Flip a switch, and behavior-based pricing is live by lunch. Regulators lagged because the guardrails were written for a different game. Old laws protect credit files you can request and dispute. Shadowed data, device IDs, hashed emails, app signals, sits outside those buckets. So institutions leaned into the gray. It's not a credit decision, it's a risk adjustment. It's not denial, it's a deposit. Language games beat the clock. Network effects did the rest. More clients feed more outcomes back to the model. More outcomes sharpen thresholds. Sharper thresholds attract more clients. Rinse, repeat. The bigger the exchange, the more it looks indispensable. A landlord thinks, everyone uses this score, I'd be dumb not to. An insurer thinks, competitors price by telematics, I can't ignore it. Adoption snowballs. Meanwhile, your personal cost curve creeps. A few bucks on a fare here, 10 on a fee there, a 5% bump at renewal, a conditional approval with an extra month's deposit. You don't see a cliff. You see a slow, quiet tide. And that's the trick. Death by small deltas you won't fight one by one. Quick micro story. A rideshare driver told me their net dropped even though rides were up. Why? Insurance telematics flagged late night shifts and hard braking in city traffic. The midterm premium rose. No crash, no claim, just behavioral lines crossed. They switched carriers, same thing. The exchange data followed them. That's how fast niche pilot becomes standard. But here's where it gets interesting. Private equity didn't just invest, they bundled. By a screening tool, by a pricing engine, by a data feed. Tie them together and sell precision across housing and insurance. Cross-sell means lower sales costs and higher margins. And because the value shows up as a small uplift on millions of people, it looks like free money. For them. For you, it's a tax. Academic and policy chatter focused on algorithmic pricing in retail, airlines, rideshare, Amazon. That's real. But the quiet shift was in approvals and premiums. Not just what you pay, but whether you get in the door. Once eligibility and price move together, a borderline risk band isn't a soft nudge, it's a wall you can't see. Isn't this safer for everyone? That's the sales line. Lower losses, fewer defaults. Sure, losses drop on paper when you price people out before losses happen. But safety for whom? If a model marks your zip as riskier, the block pays more, leaves, or stays underinsured. Those outcomes feed the next training round. The loop tightens. Now remember this number, 30. That's roughly how many seconds it takes a modern tenant screener to hit your history. Compare it to millions of past approvals and spit out an answer. Fast is good, right? But speed hides error checking. Court records mismatched? Eviction filed then dismissed? Too bad. And the culture shifted. Personalized pricing sounds slick to boards and investors. It also lets firms test boundaries at scale. If pushback spikes, they roll it back. If not, they keep it. That ratchets markets toward whatever the model can get away with. Not illegal, just relentless. So, where does that leave you? In a world where opting out is work and staying passive is costly, the run from niche to normal already happened. The goal now isn't panic, it's leverage. Break links the model relies on. Force events that require a human. Use laws that finally exist in some states to pull your file and say, show me. Because the sooner you cut the feeds, the sooner your tier stops drifting up while you sleep. The adversary map. Who's scoring you and why? Let's name names because clarity is power. At the base layer, you've got data brokers. LexisNexis Risk Solutions, owned by Arroyo, is the heavyweight. They build giant identity graphs that link your phone, emails, past addresses, utilities, court records, then layer affinities from third-party app and location data. Their RiskView and RiskView Spectrum scores turn that mess into risk bands. Stability, ability to pay, likely loss. Axiom plays here too. So do TransUnion's TLO and Equifax's alternative data units. These folk don't just sell files, they sell decision fuel. Now the screeners. SafeRent Solutions, formerly CoreLogic Rental Property Solutions, sits between you and a lease. Landlords punch in your info. SafeRent returns a score or a straight, accept/decline/conditional. First advantage and check or run hiring screens with risk signals. They brag about speed. Seconds, not days. That speed is the point. It moves landlords and employers from review context to trust the flag. And when the flag says risky, your options shrink. Insurers and underwriters are next. Think LexisNexis Telematics Exchange, where driving data flows, and CLUE, the big claims database. Add models like Attract. They score drivers off braking, speed, night driving, and where you drive. Property and renter models blend claims history with device data and address signals to set rates or caps. You won't get a letter saying your commute after midnight raised your premium, but the number shifts anyway. Then come the landlords and marketplaces. RealPage and Yurdi power huge slices of the rental market. Their approval systems plug into screeners and risk models, then push outcomes into deposits, pet fees, and monthly convenience charges. Marketplace platforms, vacation rentals, gig apps, run their own trust scores and tie those to fees and access. The logic is simple: higher risk, higher friction, higher price. Here's where private equity changes the game. Firms like Thoma Bravo, Providence, and Vista buy slices across this chain. A data source here, a screening engine there, a pricing optimizer up top. Bundle them, cross-sell them, and you've got an end-to-end stack that captures your data, scores it, sets your price, and closes the deal. Fewer vendors for the enterprise buyer, more margin for the roll-up. And each layer gets paid a little more when your tier clicks up. Why are incentives so tight? Because every node profits from precision, real or imagined. Data brokers get paid for coverage and predictive lift. Screeners sell fewer evictions and faster fills. Insurers tout loss ratios. Landlords point to lower defaults and faster leasing. Private equity counts steady, compounding SaaS revenue. Nobody's paid to build an appeal path for you. Everyone's paid to reduce friction, which means automate the no. Okay, but what actually informs those decisions? Identity linking is first. Hashed emails, mobile ad IDs, phone numbers, IP clusters, all stitched into a single persona. Public records and utilities lock it in. Then come behavioral slices. App lists, session times, late-night logins, scroll depth, chargebacks, returns, skipped payments, and address tenure. Location data adds context. Commutes, store visits, liquor or gambling stops, payday lender proximity. They don't need your name on every row. The graph does the work. Two more players you rarely see. Third-party SDKs and free apps feeding data upstream, and cloud API gateways that let mid-size firms rent a risk brain. That's why this spreads so fast. A landlord doesn't code a model, they call one. A mid-tier insurer doesn't build a telematics network, they buy exchange access. A marketplace doesn't curate signals, they embed a vendor's scoring block. Your behavior moves quietly across all of it. Alignment across layers is the quiet threat. As stability, hit from one product becomes a higher deposit through another, then a premium nudge from a third. No single move looks outrageous. Together, they trap you in an expensive lane. And because each system claims proprietary model, there's no one desk where you can say, prove it. Now zoom out. Who's scoring you? Data brokers that build the persona. Screeners that turn it into eligibility. Insurers that turn it into premiums. Landlords and platforms that turn it into deposits and fees. PE-backed stacks that synchronize the whole thing. Why? Because precision pricing prints money at scale. And because the law still treats much of this as outside credit, they can avoid the disclosures that real credit needs. Most people think they can out-nice this with perfect behavior. But the real secret is, break the links. If they can't stitch you cleanly, the score loses power. That's where we go next, what they collect, how they stitch it, and how to cut the cord. The data pipeline, what they collect, how they stitch it. All right, let's pop the hood. If the score is the price tag, the pipeline is the assembly line. It starts with identifiers. Your phone number is the spine. Your email addresses, old and new, sit right next to it. Add device IDs from your phone and tablet, cookies from sites, and your IP history from home, work, and coffee shops. LexisNexis links those to public records, utilities, and government files. That's how you becomes a stable identity, even if you switch emails or use private browsing. The phone and address graph ties it back. Then the behavior stream kicks in. Not what did you say, but how did you act? Dwell time on pages, how far you scroll, which apps you open at night, battery patterns that hint at heavy use, session length. RiskView style systems love stability signals. How long you've had the same phone number, how often you change addresses, how recent your utility payments are. Pay your phone bill late twice? That pings a stability bucket. Swap numbers after a breakup? The graph tags new line, and that can look like volatility. Location is a whole other lane. Geofencing SDKs and free apps ship coordinates upstream. Those points get snapped to places. Your commute route, your gym, a liquor store, a payday lender, a casino. One visit doesn't matter. Patterns do. Weekly stops near a gambling spot join affinities that some models map to loss odds or churn risk. Late-night driving routes raise auto-risk tiers. Live near a flood zone? Property pricing watches that too, even if you're uphill. Purchases rounded out. Debit and credit, exhaust, leak in through partners. BNPL checkouts, subscriptions you start and cancel, chargebacks you file, return rates, the gap between paydays and big buys. RiskView Spectrum-style products plug transaction history into charge-off predictors. They don't need your full statement. Signals like frequent small-dollar BNPL or multiple trial churns feed a profile of financial strain. Pair that with address tenure, and you've got a neat proxy for stability without touching a FICO file. Where do the signals come from? SDKs and apps you barely use. Weather, flashlight, wallpaper, coupon, cleaner apps, many ship device and location data by default. AdTech partners anonymize by hashing emails and IDs, then pass them to exchanges. Exchanges map hashes back to identity graphs through match keys like phone and address. That's the trick. Data can be anonymous in transit and still become you once it hits the broker that holds the keys. Linking is the glue. Hashed emails meet maids. The mobile ad IDs your phone broadcasts unless you kill them. Those meet IP addresses. Those meet your home router, which meets your cable account, which meets your name. LexisNexis brags about coverage because it fuses public records, deeds, liens, licenses, court filings with private feeds like utilities. Once the spine is set, every new crumb gets snapped to your persona with high confidence. New device? Same phone number at login, same Wi-Fi at night, same IP range at work. The graph says, welcome back. Okay, but what about consent? You gave it on paper. Cookie banners, app permissions, loyalty program terms. Allow precise location? You tapped yes to get directions once. The SDK keeps reading. Share crash analytics? Some kits bundle engagement metrics with it. Data passes through partners with different names, so the flow looks like a maze. By the time it lands at a risk exchange, it's 2 hops removed from the app you remember. Insurance telematics deserve a pause. You install an insurer app for a safe driving discount. It tracks braking, speed, cornering, phone use, and time of day. Some programs also sniff Bluetooth beacons to guess if you're the driver or a passenger. That data can route to a shared exchange. Switch carriers, and the exchange still knows your pattern. You might get a personalized rate at the next insurer before you even drive a mile for them. Rentals work similarly. A property manager submits your info to a screener. The screener pings court databases, eviction records, address history, and sometimes affinity flags tied to device or email identity. Outcomes label you as approve, decline, or conditional with a deposit. Feedback loops close the gap. If conditional tenants in Band C had more late rent, the cutoff inches up. APIs push new thresholds back into the leasing software without a meeting or a memo. Fraud and safety layers sneak in too. Device fingerprinting notes if your phone presents new configurations often. That can be fraud or a privacy habit. Models don't ask, they score. Disposable emails and masked cards reduce linkage. Good, but can also trigger friction if vendors equate privacy with risk. That's the balance we'll hit in defense. Cut joins smartly so you look like a normal, low-noise human, not a ghost. So the pipeline is simple, just massive. Identify you. Watch behavior. Map location. Read purchases. Stitch with hashed keys. Snap to a graph. Output a band. The less clean those joins are, the less confident the band. That's your opening. Break the high-confidence links, and the score loses teeth. Next, we step into the model room and see how clicks turn into price tags. Then I'll show you how to jam inside the model without blowing up clicks to price tags. Okay, so the pipeline collects crumbs. The model turns those crumbs into a price tag. Here's what actually happens, step by step, without the math fog. First, feature engineering. Think of features as little yes/no, or how much switches. Risk teams don't feed raw phone bills or full maps into a model. They turn them into proxies. Utility payment recency. Address tenure in months. Phone number age. Late night app sessions per week. Weekend spend volatility. Hard breaking rate. Each proxy hints at stability or risk. RiskView style scoring leans hard on stability. Stay put longer. Pay utilities on time. Keep one number for years. You look cheaper to insure, easier to collect from, less likely to churn. Swap phones, move twice, a couple late utilities. You slide a tier. Next, labels. A model needs examples of good and bad to learn. Where do those come from? Past outcomes. Auto insurers use claims from CLUE, loss ratios, and telematics incidents. Rental screeners use approvals, paid on time, evictions filed, court results. Card and BNPL models use chargebacks, write-offs, and returns. SafeRent-style tools label tenants approve, decline, or conditional, then treat later defaults or late rent as proof that those near the line were risky. The model learns what patterns tended to cost money. Here's where it gets sticky. Those labels reflect past systems and their biases. Eviction filings often include cases later dismissed, settled, or filed in error. But a filing is a filing in the data. Claims reflect who had coverage and who trusted the process, not all crashes. Chargebacks reflect who fights charges and who gives up. When you train on that, you don't learn a neutral truth. You learn what happened in a messy world, then you hard-code it. Training loop time. The vendor ships a model. Clients use it. Results come back through APIs. Losses, late rent, fraud hits, churn. The vendor retrains, tightening thresholds where losses spiked, easing where they overejected. Updated cutoffs push back out. No big policy meeting. Just code. That's the feedback loop. It feels efficient. It also locks in patterns fast. If one group pays more and leaves, the next round proves they were risky because they left. Protected classes aren't allowed in the inputs, so models use proxies by accident. Zip code maps to race and income. Commute length maps to job type. Phone tenure maps to wealth and age. Night driving maps to shift work. Even address tenure can map to being priced out. The model isn't evil, it's blind. It sees correlation, not cause. That's enough to move you into a pricier band. Let's talk thresholds. Scores are continuous, but decisions are bands. Under 580, decline. 580 to 640, conditional. Over 640, approve. Or in insurance, a multiplier on base rate. The money lives near the cut lines. Tiny changes flip results. Add 2 months to address tenure, you pop up a tier. 1 late phone bill and a new number, you drop. Vendors A/B test these lines like ad clickers. Where profit lifts, they keep it. Now the stability tax. Move for a better job. New lease, new utility setup, maybe a new number. The model sees churn in your identity spine and bumps your risk. That's a tax on mobility. It's also a tax on life events, divorce, roommate changes, layoffs. RiskView-style stability factors weren't built to punish you, they do anyway. Because across millions, volatility correlates with losses. You become the pattern, not the person. Price impacts look small alone. $5 on a premium. A 0.2 increase in your rental deposit factor. A BNPL cap pulled down 20%. But these hit across categories in months. Premiums stack. Fees snowball. Limits push you to worse options, which can trigger more stress signals, which feeds the loop. A quick micro-story to ground this. A teacher with spotless credit moves twice in a year, school rezoning, then caring for a parent. New number, new utilities, short lease. Driver app on to save time. Their auto renews up 12% midterm for night trips and hard braking on city streets. New apartment asks for an extra half-month deposit. BNPL lowers a limit after a spike of pharmacy buys. Nothing wrong. Just a life lived, seen as risk. Can I appeal? Not like credit. You often won't get an adverse action notice because the firm calls it a pricing adjustment, not a denial. The math sits in a proprietary model. Even with a human, they're staring at flags, not your story. So what can you do with this knowledge? 2 levers. Reduce the high-weight features you can actually control, and break the joins that make the model confident. Keep a stable primary number and email. Pay utilities on time, even if you float something else for a week. Kill high-noise apps that leak location at odd hours. If you can, time a number change right after a lease renewal so 2 big new signals don't land together. And when you face a threshold event, lease job. Insurance, be ready to request manual review and provide context before the score sets the lane. The real unlock, though, is cutting data flows so the model sees less and trusts itself less. Less confidence means softer decisions or default rates, which you can negotiate. That's where we're headed. Practical defense that changes your tier without quitting the internet. Micro-stories, real-world hits you'll never see coming. Let's make this real with fast hits you could miss in your own life. First one, housing. Mary Lewis had steady income, years of on-time rent, no evictions. The property manager ran a SafeRent solution screen. Denied. No reason she could fix. She asked for details and got a number and a color band. Weeks later, she learned a years-old court filing. Dismissed. Still sat in a database. The model didn't care it was tossed. It labeled, the landlord obeyed, and Mary paid storage and hotel fees while she appealed. That's hundreds of dollars for a ghost in a file. Same track, different name, Carmen Arroyo. Long rental history, stable job, family in tow. She applies. SafeRent flags risk. Kicks back a conditional approval with a heavy deposit. The landlord treats the score like gospel. Carmen can pay rent, but the deposit crushes her cash flow, so she walks. Months later, nothing on her credit shows a denial. There's no clean appeal path. The shadow score said maybe, which worked like no. Now insurance. A dad of 2 installs his carrier's safe driving app for a discount. He works late, drives home after midnight, brakes hard for city lights and cyclists. Midterm, the premium bumps. No crash, no ticket. He calls, they point to driving behavior. He shops around. New carrier quotes higher than expected. Why? Telematics exchange data already framed his style. He can't undrive those nights. The raise sticks. Jobs. A warehouse candidate passes interviews, clean criminal check, solid refs. Then the background screener pings risk signals. What signals? Address churn and a flagged online handle that isn't even his. Same name, wrong guy, matched by a lazy identity join. The offer stalls. The team moves on. He never sees the line item that did it because the employer calls it overall fit. Weeks lost, bills due, no fix. Travel. You search a flight twice from the same device. First search shows $238. You hesitate, check again after lunch. Now it's $262. You think supply, but the system read intent and raised your ceiling. It's not always personalized pricing, but repeated searches from one device are a strong demand signal. You pay the nudge because the clock is ticking. BNPL. A student leans on buy now pay later for textbooks and groceries, returns 2 items that didn't fit, and shops at 2 a.m. during midterms. Internal loss models see stress patterns. Late night browsing plus returns equals tighter caps. Overnight, her limit shrinks. She didn't miss a payment. No message explains it. The app's tone just shifts from friendly to firm. That squeeze pushes her to a debit card. Overdraft fees follow. Here's a quiet one: subscriptions. You bounce through trials, cancel at day 29, re-up later. Churn models learn your rhythm and start you at a higher price or strip promo offers. It's not a punishment, it's revenue optimization. Your behavior wrote your rate card. Another, renter's insurance. You plug in a quote online. The price looks fine. At checkout, a device fingerprint says you just moved, new IP, new phone model, night session. The system upsells an urban risk package and bumps the base. 2 clicks, $5 more a month, easy to miss. Gig work. A driver gets deprioritized on a platform after a fraud model links their phone to a high-risk device cluster, public Wi-Fi near a known hotspot. They did nothing wrong. Suddenly, fewer pings, more dead time. Support points to quality metrics. The model never says you were at the library's Wi-Fi. It says pattern matched. Notice the pattern. These hits don't show on your credit report. You don't get a need adverse action notice with the top 4 reasons. You get friction, deposits, nudges, and caps. You're steered, not stopped. And because it's not labeled credit, the normal rights don't trigger. Quick one that flips the script. A renter preemptively told the property manager, "I've moved twice caring for family. If a screen flags stability, here's proof of on-time payments." She asked for a human review before they ran SafeRent. They agreed. The score came back conditional. The letter overturned it. Deposit cut in half. That's leverage. Not perfect, but real money back in her pocket. So yeah, none of this feels like a big red denied. It's 1,000 gray lights that turn yellow just for you. And that's why we fight the joins and force the humans. Next, we'll trace how the laws and the money built this backdoor, and where the cracks are that you can use. How we got here, the legal and market backdoor. So how did this slip past the rules? Credit law drew a neat box decades ago. Credit files you can request, dispute, and freeze. Everything outside that box, device IDs, hashed emails, app exhaust, telematics, sat in the gray. Firms said, "We're not making a credit decision, we're managing risk." Translation, same effect, fewer disclosures. Adverse action rules didn't trigger because they framed it as pricing, deposits, fraud, or eligibility guidance. That carve-out became the backdoor. The 2010s ad tech gold rush did the plumbing. Cookies gave way to device graphs and mobile ad IDs. SDKs shipped location by default. Identity resolution, vendors learned to match your phone, email, and IP across sites. This wasn't built for lending. It was built to chase ads. But once the graphs got good, fintech and insurers realized those trails predict losses and churn. Ads met underwriting. Overnight, segments turned into risk tiers. Fintech then sold a shiny pitch. Bank the credit invisible with alternative data. Utility payments, rent, phone bills, some of that can help. But the door opened wider. If a utility payment helps, why not app usage? If rent history predicts defaults, why not address tenure and phone number age? That blur let vendors pack stability, proxies around a core of reasonable signals and call it inclusion. Investors cheered. Lower losses, higher ARPU, precision pricing at scale. Meanwhile, the policy world focused on the old pipes. FICO transparency, credit bureau disputes, fair lending tests on application data. But the real action shifted to pre-application scoring and downstream pricing, areas the laws didn't name. If a tenant screen denies you in 30 seconds based on court records and affinity flags, is that a credit decision or a property management process? If an insurer lifts your midterm premium citing telematics, is that underwriting or a rating factor? Language 1. Consent theater made it feel legit. You agreed levs in cookie banners, loyalty terms, and tap-through permissions. Precision location for a weather app? Technically, yes. Data shared with partners? Always. Hashing and anonymization calmed nerves, even as identity graphs turned those same hashes back into you. The magic trick worked because the match keys, phone address, device, live outside credit files. Ask for your report, you'll get a tidy PDF. The real file sits elsewhere. Lobbying framed guardrails as job killers. Innovation needed room. Risk teams promised fewer claims and fraud. Platforms promised faster fills and fewer evictions. Lawmakers heard efficiency and inclusion and told agencies to study it more. While they studied, the cloud turned risk into an API. You no longer needed a bank's budget to price by behavior. A mid-market insurer or landlord could flip on a vendor's model before lunch. Private equity read the room. They bought the ingredients, data brokers, screeners, pricing engines, and stitched them into stacks. Cross-sell the feed to the screener to the pricing tool, the tool back to the platform that takes payment. Each sale nudges your tier a hair higher. The gains look tiny at the person level, but at enterprise scale, they're a dream. Steady, compounding, low-churn revenue. No scandal, no headlines, just quiet extraction. You might ask, did regulators do nothing? They moved, just slowly. The CFPB dug into tenant screening errors. States passed privacy laws with rights to access and delete data. But many carve-outs remained. Insurers got wide latitude on rating factors. Background checks sat in a separate lane. Brokers claimed they weren't consumer reporting agencies when they sold marketing or risk insights, even if buyers used them for decisions. Patchwork rules met unified stacks. The myths helped. More data is safer. Sometimes, but error rates and context matter. A dismissed eviction filing is not a risk event. Night driving is not recklessness if you work the late shift. Risk-based is fair. Only if your proxies don't recreate bias. Zip code and phone tenure do. It helps the unscored. Too often, it helps vendors score everyone and charge the most fragile more. Here's the quiet accelerator: feedback loops. Once models priced people out, fewer bad outcomes appeared in the remaining pool. See, losses fell. That proof point funded the next rollout. APIs spread it to landlords and carriers that feared being the last to switch. Network effects built moats. And the longer it ran, the history hardened, more data to justify the tiers you can't see. So water found the cracks. An old credit framework guarding the front door, ad tech pipes feeding the side door, cloud APIs distributing the key, and PE stacks locking it from the inside. That's how we got here. No big bang, just a steady drift. The good news: cracks run both ways. New privacy rights, human review demands, and clean data habits give you leverage. Use them, and you raise friction on the very systems that sell frictionless no. The myths: you agreed, it's fair, it's safer. Let's shred the 3 lines you'll hear every time you push back. You agreed, it's fair, and it's safer. They sound reasonable. They're not. You agreed. To what exactly? A 4-screen cookie wall with a green button and a grayed-out manage options? An app permission that says allow precise location for better features? That's not real consent. That's consent theater. You tap because you need directions, or rent is due, or a job form won't load. And buried in share with partners is the data route to brokers and risk exchanges. Hashing your email doesn't fix it when the same broker unhashes the map with your phone number and address history. If you wouldn't sign a paper contract that says price me higher for driving at night, why is a tap-through permission treated like a lifetime waiver? Now the fairness pitch. Risk-based pricing is fair because lower risk pays less. Sounds tidy, but fairness dies in the proxies. They swear the model doesn't see race or age. It doesn't need to. Zip code maps to both. Commute length maps to job type. Phone tenure maps to income and stability. Address churn can mean you're priced out, not irresponsible. A dismissed eviction filing still reads as eviction filing. And when screeners train on landlord outcomes, they learn the old system's blind spots as truth. That's not fairness. That's math painting over bias with a fresh coat. You'll also hear, more data helps the unscored. Sometimes, sure, clean rent and utility history can open doors. But more data quickly becomes all data, and that net catches noise. Late-night app sessions during finals week? Stress. 2 returns and a BNPL order? Credit seeking. New number after a breakup? Volatility. The unscored become hyperscored. Instead of 1 file you can dispute, you get 100 microsignals you can't even see. Inclusion morphs into a new tax on life events. It's safer. For whom? Carriers show loss ratios dropping after telematics. Landlords show fewer evictions. But look at the mechanism. If you price people out before they enter, losses fall by selection, not by magic. When a block pays more due to a zip proxy, the ones who can leave, leave. The ones who stay, underinsure or risk more. Next training round, the model proves the block is still risky because the remaining pool had worse outcomes. Safety looks good on a slide. It feels like scarcity when you're living it. Errors are rare. Great, then prove it. Court databases mismatch names. Eviction filings list wrong units. Telematics confuses driver and passenger. Device graphs merge two roommates into one person because they share Wi-Fi. You don't see those joins, so you can't fix them. Credit law gives you a report and a dispute lane. Shadow scores give you a nudge and a shrug. If errors are rare, open the file. If you won't, don't ask me to trust the black box that raises my bill. But you can opt out. Of what exactly? One broker? The signals keep flowing through SDKs and partners. One insurance app? The exchange still holds last year's trip data. One tenant screener? The property manager uses another. Opt-outs are scattered and brittle. That's why we stack defense. Kill the mobile ad ID, cut app trackers, mask emails, rotate privacy cards, and use state rights where they exist to request, delete, or correct. Opt-out isn't one switch. It's a routine. Personalized pricing rewards good behavior. Sometimes, yeah, but it also lets firms push until you squeak. If no one squeaks, the price stays up. That's not a moral system. That's a test lab. Good behavior becomes the floor for more tests. Miss once, and your signal flips fast because the model trusts itself too much. Here's the part they won't say. These lines, you agreed, it's fair, it's safer, aren't built to help you understand. They're built to keep you quiet. You're not here to be quiet. You're here to take control. So when someone waves those myths, ask for specifics. Which partner? Which proxy? Which right can I use today? Then use it. Because the second you demand receipts, the shadow
Personal
score
defense,
gets sunlight, practical moves
sunlight
that
change
change
the
the tier.
game.
Okay, let's get hustling. Defense first. We're going to lower your risk noise, break high-confidence joins, and force human eyes when it counts. Simple moves stacked weekly, save real money, no joke. Start with your identifiers. Keep one stable public number and email for banks, taxes, and insurance. Lock them down. Then create masked lanes for everything else. Use email aliases for signups. Think plus aliases or a privacy relay. For texts and two-factor on random sites, use a secondary number from a reputable VoIP or a privacy service. This splits your life. Stable spine for legit stuff, throwaway for trackers. Your shadow score hates fuzzy joins. Kill your mobile ad ID. On iPhone, settings, privacy, tracking, deny tracking and reset the identifier. On Android, settings, privacy, ads, delete ad ID. Do this every month. While you're there, turn off background app refresh for apps that don't need it. Weather and coupons don't need midnight data drip. Less background noise, fewer location pings, lower late-night activity flags. Prune apps, no joke. If you haven't used it in 30 days, cut it. Especially flashlight, wallpaper, coupon, cleaner, and random keyboard apps. Many ship SDKs that leak device and location. Keep only what you trust. And check permissions. Set location to while using for maps and rides. Never for everything else. If an app breaks without precise location, ask yourself if it's worth the data tax. Payments next. Debit leaks your life. Shift everyday spend to a privacy card that creates masked numbers per merchant. It blocks merchant-to-merchant linking and stops card-on-file sprawl. Use a separate credit card just for subscriptions. If a service leaks, you close one card, not your whole wallet. And don't connect bank aggregators to your main account unless you must. If a budget app wants full access, feed it a checking account you keep lean. Location hygiene matters. Home and work are anchor points. On your phone, disable significant locations or location history. Clear it monthly. Turn off Bluetooth when you're not using it, beacons track. In your car's infotainment, delete paired devices before you sell or service. For Wi-Fi, give your home network a bland name. No address or surname. Your router's SSID leaks into IP geolocation databases that fuel home identity joins. Insurance telematics? Negotiate or opt out. Ask your agent for a flat rate plan that doesn't include usage data. If you must enroll, set clear boundaries. Confirm whether data goes to a shared exchange. If they won't say, assume it does. If the app guesses driver versus passenger poorly, push support to mark trips manually, then set a reminder to audit weekly. If the premium bumps midterm, request underwriting notes and ask for a reevaluation based on misattributed trips. Rentals and jobs are threshold moments. Force a human. Before a landlord runs SafeRent or similar, disclose context. I moved twice for family care. Here are 12 months of on-time payments. Ask, in writing, for manual review if a screen flags stability. If they decline, request the screening company's name. That tells you who to send your dispute to if state law gives you that lane. Speaking of lanes, use your rights. In states with privacy laws, submit data access and deletion requests to data brokers and screeners named in your paperwork. LexisNexis Risk Solutions, SafeRent Solutions, TransUnion's TLO, Equifax's AltData Arm, plus People Search Brokers. Keep it simple: access, delete, correct. Track requests in a Notes app with dates. Calendar a follow-up in 30 days. Build a weekly routine. Sunday night, 5 moves. Prune 1 app, rotate 1 email alias, reset your ad ID, audit 1 permission set, and Q2 opt-outs at big brokers. 15 minutes, done. Monthly, rotate your masked card for risky merchants. Review subscription spends on the dedicated card, and reset router firmware if it's old. Quarterly, call your insurer and ask for static pricing options. Ask your landlord to note on-time payments in your file ahead of renewal. Time-sensitive changes smart. Big life shuffles, new number, new lease, new job, create a stability dip. Spread those over a few weeks if you can. Don't change your number and move on the same weekend. Give the graph less to latch onto all at once. For gig workers and freelancers, tame device fingerprints. Keep your work browser clean. One profile, no random extensions, privacy first ad blocker, and cookies cleared on exit. Use a separate profile for personal. Platforms read chaotic fingerprints as risk. Look normal, not noisy. When you hit friction, document. If a rental turns conditional, ask for the specific screener and score band. If insurance hikes midterm, request the reason code. If a job stalls, ask whether a third-party screen flagged non-criminal risk signals. You're building a paper trail. With it, you can dispute, escalate, or even file a complaint if laws in your state back you. Last thing, don't ghost yourself. Over-obfuscation can trigger fraud flags. The goal isn't to vanish, it's to look like a stable, low-noise human with clean lanes. Stable main number and email. Tight app list. Minimal location leakage. Masked payments. Time changes. Human review on thresholds. Stack these, and you'll feel the drift stop, and some prices slide back your way. For real though, this is how you take control. Systemic levers. Push back where it hurts. Defense helps, but offense changes the game. You need moves that create cost and risk for the system scoring you, and receipts you can use when they push back. Here's how to hit them where it hurts. Start with data rights. In states with privacy laws, you can request access, deletion, or correction from data brokers and screeners. Aim at names that actually touch pricing and eligibility. LexisNexis Risk Solutions, SafeRent Solutions, TransUnion's TLO, Equifax's alternative data units, plus People Search Brokers that seed identity graphs. Keep requests short and plain. Provide all data you hold on me. Identify sources, recipients, and scoring. Delete where permitted. Attach a photo ID and proof of address to avoid stall tactics. Track dates. If they miss deadlines, file a complaint with your state AG or privacy office. Paperwork slows vendors and forces internal reviews. That friction costs them time and money. Use opt-out portals, but do it with a calendar. Many brokers bury opt-outs and quietly re-ingest your data months later. Build a persistence loop. A master list of broker links, submission dates, and 90-day reminders. Resubmit on schedule. Think lawn care, not one and done. Bonus move. When a portal asks for extra data to find you, give the minimum, full name and current address. Never old addresses or extra emails. File disputes when you're denied or priced up. If a rental turns conditional or gets denied, ask for the screener name and the exact reason codes. If insurance hikes midterm, request the underwriting notes. Use their words back at them. You used behavioral or alternative data to make an eligibility or pricing decision. Provide the key factors, sources, and your appeal process. Some firms will say, not a credit decision. Great. Now you can document that they made a consequential decision without offering credit file protections. That record is leverage with regulators and sometimes with a supervisor who doesn't want heat. Demand adverse action notices whenever the outcome feels like a no, even if they call it conditional. You're not arguing law on the spot. You're signaling you know your rights. Please provide an adverse action notice identifying the consumer reporting agency or data source used and the top factors. Best case, they cough up the screener and codes. Worst case, you capture their refusal in writing, which helps if you escalate to the CFPB or state regulators. Local wins matter more than tweets. Cities and states are passing privacy laws with private rights of action and teeth. Join or support local tenant unions, driver groups, and freelancer collectives pushing for required disclosures on automated screening, mandatory human review on request, ban on eviction filings less than X years old, limits on telematics for rating, clear opt-out for data brokers that must propagate to downstream vendors. A small ordinance can force manuals and audits inside giant stacks. Those costs curb the worst behavior. Collective action is a cheat code. Patterns hide at the individual level, but scream in groups. Tenants in one building share screening bans and deposits. Drivers compare midterm premium bumps tied to night driving. Freelancers log which platforms downrank after device fingerprint changes. Put findings in a shared doc with dates, screenshots, and dollar impacts. When a reporter or regulator calls, you've moved from vibes to evidence. Companies respond faster to clusters than to solos. Hit vendor contracts if you run a business. Audit SDKs and trackers in your apps and sites. Cut any that ship location or device data you don't use. In your contracts, add a no-share clause. Data collected to perform service X may not be sold, rented, or used to build third-party risk or marketing profiles, full stop. Require a data map, subprocessor list, and breach/abuse notice within 72 hours. Violations trigger fee credits. Vendors obey money. Force internal escalations. When support shrugs, ask for escalation to the Office of the President or Executive Customer Relations. These teams exist to avoid regulator attention. Present a crisp packet. Timeline, screenshots, dollars at stake, and the specific remedy you want: manual review, deposit waiver, premium rollback, or a written confirmation that they won't use telematics exchange data. Make the fix cheaper than the fight. Use timing and public pressure. If a landlord leans on a broken screen, cite the CFPB's tenant screening. Report and ask if they're comfortable being named in a complaint. Stay calm, no threats, just facts and your next step. Same with insurers. Reference telematics misattribution issues and ask whether their UBI program participates in a shared exchange. Say you'll note their response in a state DOI inquiry. You're not bluffing. You're opening 2 tabs. Document every step. Save PDFs of forms you submit, auto-replies, and deadlines. When the clock runs out, send a short nudge with the subject, second request, statutory deadline. Regulators love tidy files. Companies hate them because tidy files travel. Last piece, measure your wins. Track premiums, deposits, and monthly fees before and after your pushes. If an opt-out drops a subscription's personalized price back to baseline, note it. If a manual review cuts a deposit, note it. Seeing the savings keeps you going and helps others copy the playbook. You don't have to win court cases. You have to raise the cost of lazy automation and make manual review the path of least pain. That's how you bend the system. What's next? The coming scores you'll face. All right, quick look ahead, because the score isn't stopping at rent and car insurance. It's creeping into places you don't expect, and it'll change how you move, shop, and travel. Health-adjacent risk is first. Wearables, pharmacy loyalty cards, grocery memberships, those feeds sketch your habits. Steps up, sleep down, late-night pharmacy runs. Insurers say they won't use health data to rate you, then build wellness discounts that act like reverse surcharges. If you opt out, your base rate drifts up while engaged folks get the lower tier. Same end. Behavior sets your bill. Mobility tiers get tighter. Your driving score already tweaks premiums, but it won't stop there. Parking prices that rise if you arrive after midnight. Toll discounts that prefer steady drivers. City congestion fees that adjust by vehicle risk class. Even car rentals can read exchange data and pre-bake your deposit. Think of it as a lane assignment for your wallet. Drive style equals pricing lane. Smart home risk is coming to renter and fire coverage. Water sensors, door contacts, thermostat logs. Insurers love pre-loss signals. They'll start as discounts. Install a leak sensor, pay less. Then invert. Base rates assume you have sensors, and folks without them pay more. Device alerts feed claim decisions, too. If your logs show no water flow, the claim gets hard questions. Your home turns into a telematics box. Subscriptions will get a churn score that sets what you pay monthly. If you cancel often, trial hop, and return later, expect fewer promos and higher starting prices. Some platforms will use propensity to upgrade to nudge your base plan up front. Not illegal, just math. The trick is they don't call it personalized pricing. They call it offer management. Feels nicer, costs the same. Travel trust scores will run in the background. Cross-border checks already pull on risk feeds. Hotel and car rental desks will tie deposits and age waivers to third-party trust bands. Missed flights, last-minute bookings, throwaway emails, prepaid cards, they add friction. Return travel to certain regions can trip manual holds you don't see. You'll hear policy, not profile. Debanking risk is the one to watch. Fraud models are sweeping. False positives hit freelancers and small shops hard. A burst of invoices, new device, travel IPs, boom, account review. Payments get held, then closed per terms. You'll get a vague fraud line, not a fix. Banks and processors will lean on network signals. Shared device clusters, IP ranges, chargeback neighbors. If your work life looks new, keep a backup processor before you need it. Insurance will borrow from retail and vice versa. Home insurers might read your purchase patterns. Lots of big box home fixes after storms? They'll see maintenance lag or repair exposure. Retail memberships might flag resale risk if you buy hot items at volume, then nudge limits or hold funds longer. It's one graph, many knobs. Employment will see a reliability layer, even if HR swears they don't. Not a score on paper, signals that route applicants to fast lanes or slow lanes. Frequent address changes, night logins on employer portals, long gaps, mismatched device/location. You won't get a no. You'll get silence. The defense is the same, preemptive context and a human. Education and skills platforms will rate completion risk. Discounts if your profile looks steady. Higher upfront fees if you seem likely to drop. Financing for boot camps will bake in these bands. They'll say it's about support. It's about price. Gig and marketplace trust will blend device fidelity with on-time history. New phone. You may get fewer high-value jobs for weeks. Shared IP. Your rank slides. High cancellation days after storms? Your score dips. They'll frame it as community quality. Crypto and fintech will tighten identity friction. If your persona looks composite, many emails, masked cards, VPNs, you'll see slower withdrawals, higher fees, and hard holds after spikes. Some of this is fair. A lot is just broad brushes. So, what do? 3 plays. 1. Keep your clean lane clean. Stable main number, email, and payment for serious stuff. 2. Split the rest. Masked emails, privacy cards, and trimmed app list to cut noise. 3. Create receipts. When a system gates you, ask for the source and reason in writing and request human review. That combo stops surprise tears from sticking. And if you run a business, steal the same logic, but ethically. Use first-party, consented data to reward good signals you define, on time, kind, engaged. Kill the trackers you don't need. Tell customers what you don't collect. That trust beats a smart price every day. The scores are coming. Some you'll see. Most you won't. But once you know the patterns, you can bend them. Keep your lane stable, cut the leaks, ask for a person, and you'll pay less than the guy who shrugs. For creators, freelancers, and small biz, flip the script. If you sell anything online, you're playing both sides. You're scored by vendors, and your buyers judge you in seconds. So flip the script. Build clean data lanes you control, earn trust on purpose, and still make money. It's not hard. It's habits. Start with the plumbing. Separate domains for marketing and ops. Use a clean root domain for billing, support, and account logins. Spin a subdomain for ads and landing pages. Different pixels, different cookies. Why? If your ad stack gets messy, it won't contaminate your checkout. Less noise equals fewer fraud flags and smoother payments. Next, pick one CRM and one analytics tool you actually use. Kill the rest. Every extra tracker is a leak and a latency hit. Tag the events that matter. Email signups, add to cart, purchase, refund, support ticket. That's your first-party data. You own it, consented. Everything else is rented risk. Pixels, run the bare minimum. If a partner insists on a script to improve experience, ask for a server-to-server option or a static pixel. No SDKs that hoover location. In your tag manager, set hard rules. Only fire on needed pages, never on account or checkout. You'll cut load time and stop feeding third-party graphs you don't control. Now, pricing fences you control. Reward signals you define and can explain. On-time buyers get auto-applied renewal discounts. Low refund customers get free expedited shipping after 3 orders. Members who complete onboarding get a locked base rate for a year. Make the perks clear and predictable. No surprise surcharges for night usage nonsense. Build a consented list the simple way. Lead magnet, yes, but make it useful. A setup checklist, a contract template, a calculator. Ask for email, not a life story. Double opt-in. On the thank you page, tell them exactly what they'll get and when. That single truth beat will drop spam complaints and raise open rates. ARPU follows trust. Vendor audits save you cash and headaches. Quarterly, print your site's network calls. If you don't recognize a domain, investigate. Access SDKs in your mobile app that you don't use today. If you need analytics, prefer privacy-first kits that don't share data downstream. Your users aren't a product. Say it plain on your site. Contracts matter more than code. Add a data clause. Data collected to perform service X may not be sold, rented, or used to build third-party risk or marketing profiles. Require a subprocessor list, breach notice in 72 hours, and deletion on termination. Put fee credits for violations. Vendors straighten up when money's on the line. Payments, split risk. Use one PSP for subscriptions and a backup for one time. Keep high-risk SKUs on the sturdier processor with tighter fraud controls. Low risk on the cheaper rails. That way, a fraud wave doesn't choke your whole cash flow. And send level 2 and 3 data for B2B cards to slice fees. That's free margin. Fraud rules should be transparent, not twitchy. Set velocity limits, yes, but whitelist repeat customers fast. Add a friendly challenge flow that asks for a quick email reply instead of killing the order. Every false decline hurts LTV. Explain the why, earn the retry, keep the sale. Now the story. Tell customers what you don't collect. No precise location. No third-party trackers on checkout. No selling lists ever. Put it on a simple trust page. Show your data map in human words. People share when they understand, and they buy when they trust. Financial freedom loves trust. Microstory. A small DDC brand cut 5 trackers, moved to 1 CRM, and added a trust page. Page speed up 28%. Chargebacks down. Email revenue up. The kicker? A big box buyer said yes because their security team saw clean lanes. That PO paid for the whole change. For freelancers, keep a clean lane too. 1 domain email for clients, 1 device profile for work, 1 invoicing system. No random extensions. You'll dodge false. Fraud flags on client portals and get paid faster. Been there, done that. Finally, measure what matters. Track repeat rate, refund rate, chargebacks, time to first value, and support lag. If a tool doesn't move one of those, cut it. Simpler stack, higher trust, better cash flow. That's how you take control, serve customers, and make money without joining the surveillance circus. Power moves, a 1-page action plan. Let's lock this in with a simple, repeatable plan. 1 page. You follow it, you save money, you take control. Weekly, 5 moves. 1. Delete one unused app. Start with flashlight, wallpaper, coupon, random cleaner. 2. Reset your mobile ad ID. iPhone, deny tracking and reset. Android, delete ad ID. 3. Audit one app's permissions, set location to while using or never. 4. Rotate one email alias for new sign UPS. Keep your main email stable for banks and taxes. 5. Q2 broker opt-outs. Hit LexisNexis Risk Solutions and a people search site this week. 2 more next week. 15 minutes, done. Monthly, tighten payments and identity. Swap your masked card number for any sketchy merchant. Review your subscription-only credit card. Kill trials you forgot. Reset router firmware if it's ancient. Rename your Wi-Fi to something bland. Clean browser profiles. 1 for money, 1 for shopping, 1 for social. Clear cookies in the shopping profile so churn models lose their grip. Quarterly, renegotiate the big bills. Insurance. Ask for a static rate plan with no telematics, or proof your UBI data isn't shared to an exchange. If they hedge, shop quotes while you're still covered. Rent. A month before renewal, send a short note with screenshots of on-time payments and a request to note strong payment history. Ask to remove junk fees or trim deposits tied to screening bans. If they say policy, ask for the policy doc. Paperwork opens doors. When you're denied or conditional, trigger the human lane. In writing, request the screener's name. your score band, and the top factors. Ask for manual review with context you can prove. Attach pay stubs, utility receipts, prior landlord letters. If they refuse, save the refusal. You're building a clean file you can take to a regulator or a supervisor. Calm, firm, specific. Big wins live in 5 switches. 1. Stop selling your location. Kill precise location for every app except maps and rides, and even those while using. 2. Split identities. Stable number and email for the serious stuff. Masked emails and privacy cards for everything else. 3. Opt out of telematics. If you can't, audit trips weekly and dispute misattributions. 4. Cut SDKs. If you run a site or app, remove trackers you don't use. 5. Demand an adverse action notice anytime an outcome blocks you. It forces a paper trail or a useful refusal. Keep score like a hustler. Make a note called Shadow Score Wins. Log your baseline, rent deposit, auto premium, renter's insurance, BNPL limit, random fees. Each time you run the playbook, record the change. Premium rolled back $14 a month? That's $168 a year. Deposit cut by $400? That's a real cash win. Seeing the stack will keep you moving when life gets busy. Build your broker queue. Start with LexisNexis Risk Solutions, SafeRent Solutions, TransUnion, TLO, Equifax's alt data units, plus the top people search sites. Submit access, deletion, and correction where the law allows. Give only the minimum data to find you. Calendar 90-day follow UPS. If a broker resurfaces you, resubmit and note the repeat. Persistence is the edge most folks never use. Protect the clean lane. Don't change your main number and lease in the same week. Space big identity moves by 30 days if you can. Stability proxies are time-weighted. Give them time to settle. If you work for yourself, clone this plan for your business. Quarterly vendor audit. List every pixel and SDK. Kill non-essentials, and add a trust page that spells out what you don't collect. Contracts. No data sharing beyond service delivery. Subprocessor list required. Deletion on termination. Payments. 1 processor for subs, 1 for one-time, L2/L3 data for B2B cards to cut fees. Your fraud rate drops, approvals rise, cash flow steadies. Financial freedom loves clean pipes. Microscript for calls and emails. Steal this. I'm requesting a manual review. Automated screening may flag stability due to recent family care moves. Attached are 12 months of on-time payments and employer verification. Please confirm the screening vendor and any adverse action notice you'll provide if conditions remain. Short, polite, specific, and it signals you know the game. Last, build a small circle. Tenants in your building, drivers on your route, freelancers on your platform. Swap notes on deposits, midterm hikes, and weird flags. Patterns pop fast in groups. When you spot one, document dates, dollars, and screenshots. Send a joint note to support or your city's consumer office. Companies move when clusters. Complain with receipts. That's the page. Weekly 5. Monthly tighten. Quarterly negotiate. Document frictions. Demand humans. Cut leaks. Track wins. Do this for 90 days and tell me your bills didn't move. Here's the point. Hidden shadow scores price your life, but clean lanes, tight habits, and human reviews put money back in your pocket. If this gave you leverage, hit subscribe and share it with one friend who keeps getting conditional for no reason. Then watch my deep dive on data brokers to nuke the worst leaks fast. Your future self will thank